you a trader or business owner? Or anyone just wanting to learn how to be healthier, better, and more business savvy? You've come to the right place. Welcome to A Trader's Life with your host, Rick Mazer.
Hey everyone, 2 quick things before we begin. If you enjoy these episodes here on the show, please don't forget to follow us on your favorite podcast platform wherever you listen to audio. It's a great way to be reminded when new episodes are released. You can also rate and review the show as well, which helps to spread the word to new listeners. Also, if you're interested in trading the financial markets and curious about stocks, options, futures, forex, and more, please head over to my website at rickmazer.life. Be sure to join our mailing list. We are currently in private beta with Enlightened. Enlightened is a trading community and will provide great information and lots of free resources. We have tons of things planned for expansion to give anyone interested in becoming better at finance, investing, and trading your money some great opportunities. Get on the mailing list today and let's get trading and better at managing our money. Charles, how are you?
Doing well, thanks.
Doing well. Great to have you. So I wanted to have you on because you have an interesting story. You have a book. You have a lot of different things going on. And I think it would be good for people to hear from you and get some good information. So just briefly tell us how you started, grew up, everything like that. Give us a little background of your history.
Yeah, sure. So my accent's probably a bit of a giveaway. I'm British. I was born in London. I did most of my education here, but I then later went out to China for university there, and I lived there for 4 years. My wife's actually Chinese, so I brought a bit of China back to the London, where I'm now based with my 2 daughters. And investing has always been very much a passion for me.
So you speak multiple languages as well?
Yes, yeah. Although it's waned a bit. But yeah, when I was out in China, I did my degree in Chinese economics and trade.
And you run an investment fund, and is that what you're doing right now? Still, or?
Yeah, so I was formerly at Jupiter Asset Management, which is a London-listed fund manager. I think it's about $50 billion under management. I obviously wasn't managing all of that. I co-managed on the emerging market fund there, a London-listed investment trust. So that was the primary kind of means that I've been investing. More recently, actually, I've been writing this book, the Company Valuation book, which has taken most of my time. Obviously, also investing on my own behalf on the side as well.
Your own money?
Yes, yeah, very much so.
How long did the book take you to write?
I had expected that it would take me 2 to 3 months. I targeted about 50,000 words, and I can normally trot off 1,000 words in a day, so I thought it can't really take that long, but it took me about 5 months. What I found with writing actually is that there's a lot of reading around a topic. No matter how comfortable you feel with a topic, you always want to read more, understand differences of opinion, where you may be wrong. So there was a lot more reading around to get the book completed than I anticipated. So I'd say, yeah, 4 or 5 months in total.
And primarily, just to go back a little bit, you deal with alternative investment analysis, valuation, or what is your specialty?
Yeah, my speciality is really long-term equity investing. And that's the type of approach I advocate in this book as well. What you learn there, though, is obviously is more broadly applicable to that. So those with a kind of shorter-term horizon could also apply it. And equally, those seeking to invest in alternative options, derivatives, fixed income, there's plenty in there that would also be applicable for those looking at those asset classes.
Do you trade on the London exchange or the US markets as well?
I have traded things in the US market as well. So no matter which country you're in, if you're a tech stock, US is still the most attractive market for. So especially when I used to look at China, for instance, I ran a kind of different China fund as well, actually, alongside the emerging market fund. A lot of the tech stocks there, Alibaba, JD.com, NetEase, these are all kind of US listed companies. In fact, many of the most attractive and high growth businesses in China are listed in the US.
Yeah, because I think a lot of people who are listening who are thinking about investing and want to put some money to work, they're just trying to figure the stock thing out. Yeah, they don't know what to do. They don't know where to go. They don't know how to value a company properly. Everybody wants to jump on the the Bitcoin bandwagon and the GameStop and all that other kind of stuff. And that's great for short term, but I don't think that's something, obviously, for years and years in the future. You need to have something more solid. And you're more of a value fundamental type of guy, value the company, look at the cash flow and all that kind of stuff.
Yeah, I often get pigeonholed into being a value investor, although I think the term value investing is slightly silly in itself. Everybody should be going into kind of buying assets, not because they're overvalued, because undervalued. And while I would say I got a very strong valuation discipline when I go to buy a company, typically I like higher growth, structural growth opportunities, so businesses that I feel comfortable can not just grow in the coming years, but also the coming decades. And very much, I agree with you. There's plenty of people out there interested in this field. And indeed, I very much wrote this book because I was one of them a decade or so ago. And I found it very frustrating trying to find some material, how to learn, how to adequately invest in a company. Very much, you've got a range, you've got a lot of content which is too simple, perhaps, that you can pick up off a website, how to do simple multiples. And quite often, a little bit of information is more dangerous than none at all. You suddenly feel perhaps overly confident without mastering really the forces that affect a company's long-term value. And then at the other end, you got a whole host of very academic, very complex, not particularly accessible work. So this book, I hope, is really just a mid-road in that sense for somebody who wants to make informed investment choices and be able to look beyond just the headline multiples or the headline kind of valuation techniques, which individuals often use.
So you're not really a technical analysis guy so much?
No, I wouldn't. No.
Okay, which is fine. Yeah, some people believe in technical analysis. Some people believe in valuation. Everybody's got their own take. We do deal with day trading a lot, and which deal with obviously more technical analysis because it's shorter term. But we get a lot of people that also ask, hey, we have some extra capital here. We want to diversify it. What do we do? I like to buy some stocks and pick some stocks or funds, but they just don't know how to do it. So, and that's not really my forte either. I'm not a specialist in that by any stretch of the imagination. So how did you come to decide that this is the way you wanted to invest? That might be a hard question, but why not technical analysis versus more value or long-term stuff?
Yeah, sure. So I enjoy looking and understanding companies. And so I enjoy speaking to people, speaking to management, getting to know the businesses. And so that was the real driver. I had looked at kind of technical analysis, shorter term stuff, but in my view, that was a bit more of a lonely road. There's far less engagement, obviously, with others, with the company, with investor relations, financial direct, all that kind of world. You don't so much get with technical analysis as you perhaps do get with longer term fundamental investing, where you do really feel that you're a part of a company's journey rather than perhaps just a pass for the short term.
Well, I am an advocate that people should definitely take this into their own hands. I know especially in 2008, when the crash happened there, I had money invested on my own, and I also had money with a financial advisor. And what I found out was when the market dropped 40%, they lost as much as I did. And I consider myself not really knowing what I'm doing too much. So I always tell people, if you can put the time in and the effort and you can get some skills, which again, I know going back to your book can probably provide people, you can probably do just as good, if not better, than giving your money to somebody. Not that that's a bad thing. I do believe, again, in diversifying and spreading it around, but certainly it's something people can do. And your book, when you talk about this, would really work in any market, right? It doesn't matter if it's developed or emerging or anything like that.
Yes, I've very much written it so it could be used for any company, any industry, any market, developed or emerging. A lot of my experiences in emerging, but plenty of the examples and anecdotes in the book are actually for developed companies.
Okay.
Although I don't...
Do you...
Sorry, and although I don't really touch on short-term investing, I do think actually there's quite a bit of content there that would be helpful for those that want to combine the two. So, for instance, understanding short-term events in terms of materiality and effect on the long-term value of the company. I think you can sometimes understand and frame short-term opportunities perhaps a bit better when you have that kind of broader understanding of the forces that affect a company.
I know a lot of people, they want to invest. Obviously, they know the U.S. markets. They want to invest in other markets like China. But you hear all the time, especially in the U.S. here, I don't trust the China numbers. You don't know what's going on there. So how is somebody supposed to really value something if they can't even trust the numbers? I know it's probably a matter of picking the right companies, but is there any advice you can give somebody in that regard of what to look for?
First, I totally sympathise with anybody that wants to stick with their home market and stick with what they know. I think if you've got limited time, that makes sense. In terms of China, it's a fascinating market, obviously huge country, a real scope of risk and opportunity. And as you say, there have been quite a few incidents of where the numbers haven't stacked up at the macro level as well as the company level, it must be said. That being said, in my view, China does have some of the most attractive bottom-up opportunities of any asset class. And it's partly because it's got that reputation as a country for perhaps lower corporate governance standards, some of the issues that you perhaps get being a developing nation. But I absolutely hear what you say, and I always tell people fully appreciate that China is a higher risk economy if you're going to go and put your money there.
Exactly. I was reading up on you a little bit, and you used the term behavioral bias. What is that, and how can we avoid it?
Yeah, so the behavioural bias section of the book, I think, is certainly one of the more interesting chapters. It's something that kind of we very much all fall short of, fundamental investors. Obviously, technical investors don't quite have this problem. Often, there's a great quote from Warren Buffett who said, "Investing success doesn't correlate with IQ after you're above a score of 25. Once you have an ordinary intelligence, then what you need is the temperament to control urges that get others in trouble." And there's a whole host of these behavioural biases. It's a bit of an investing field in it. The key breakdown, which people normally do, are cognitive biases and emergent and emotional biases. So cognitive biases would, for example, include anchoring, where psychologists have found that people tend to rely too heavily on the very first piece of information that they learn, even if that piece of information isn't particularly relevant. So for investors, for example, there's various ways that anchoring can commonly manage historical values such as acquisition price or high watermarks. Although these numbers may be totally irrelevant to a company's value, quite frequently as an investor you will think you'll think of a company's value in terms of where you had purchased it rather than what its calculated fundamental value should be. The other key field of behavioural bias is emotional bias, so a loss aversion, regressive, overconfident. Again, these all affect the way that we actively participate in equity markets, and understanding those and knowing how to overcome those can be very powerful in terms of self-development and becoming a more objective fundamental investor.
Yeah, I think that's the key, because it's easy to fall off the track, especially if you get emotionally caught up in everything besides the behavioral stuff. I know, I just going back to the whole day trading thing, you have to have rules. You have to have a formula that you follow to do things. And I guess people feel with longer term, you have more time. You're not in a trade like we are, maybe in a day trade for an hour or two. You might be in it for a month or two or a year or 2 years. And people feel like, hey, I can get in and I can just pull the trigger and see what happens and adjust if need be. But I do think that before you put the trade on, you have to have a good rule set in place. So when it comes to people who are trying to invest, do you have any valuation tools or any examples in the book that can help people specifically with, here, I'm interested in stock A, B, or C. What do I do? How do I go about looking at this?
Well, yeah, so professionals the world over really break down valuation tools into two separate areas. One is intrinsic valuation, where you base the valuation of a company on the returns that it will generate over time and adjust that for what's known as the time value of money and risk. And the other one, which people are probably recognize more is relative valuation, and that's the idea that similar assets should trade at similar values. So just to take an everyday example, for relative valuation, for example, if you were to purchase a property, you would very likely look for similar properties down the road. Quite often people will go one step further and look at the value of a property as price per square foot. In the same way, we can do that with companies as well. We can standardize the valuation of the company by anchoring the valuation against a performance metric such as earnings or sales or cash flow, and thereby getting what we call a valuation multiple. So the most well-known multiple out there is the price to earnings multiple, and what that tells you is what multiple of earnings you're paying for a company. So for example, if a company was worth $100 million and produced $10 million of profit the last year, you could say that it was worth 10 times historic profit. And then as an analyst, what you'll do is you'll look at similar companies with similar risk return profiles and say, is this a fair value or is it under or overvalued?
So it sounds like you can get a lot of good information on breaking everything down from the asset to the price to what's going on and everything, and get a good feel for things to make better choice, which is important as well.
All of that information is very readily accessible, actually. Yahoo Finance, Google Finance, a lot of websites now, you don't have to calculate these multiples for yourself. You can simply go onto some of these websites. They've got the peer groups, they've got the multiples already, so you can make a quite quick assessment yourself, quite a high level assessment of if a company may be worth doing further work on.
So you just need to know, once you make that assessment, you need to know the formula of do A, B, C, and D to get to the point where, hey, I want to pull the trigger on this thing and invest. And that's what the book helps with in some sense, right?
Yeah, exactly. So in the book, I give a bit of a checklist. So I call it the court, castle, and moat approach. And it's a way for really trying to make sure that your approach to investing is process driven rather than being perhaps affected by the behavioural biases. So for the court, for an assessment, for instance, you'd be looking at not just the capability of management, but accountability. So is there an independent board, etc., and alignment of interests. So for example, are management paid in shares? What proportion of their remuneration is variable? What proportion ownership do they hold, etc.? And then the castle part of that would be simply, is it an attractive business with good prospects, margins, returns, etc.? And that final point, the moat, from Court, Castle and Moat, I actually pinched this part of it off Warren Buffett, who talks a lot about economic moats. And the idea is that you want to find, ideally, a business with a good moat, meaning that those returns, the attractiveness of the castle, should more likely be sustainable over time. It's less at risk from competitive forces, say.
That's good information. So you have some books that you listed that you like. People always ask me about books. Everybody wants to know about the markets and everybody wants to know how they can get information or read about people. And I saw that you do have these books, and a couple of them were interested in me. I've actually read a few of them myself, but not all of them. And the first one I just wanted to talk about a little bit was The Accounting for Growth. You like that one, huh? A lot?
Yes, yeah. The chap that wrote that, actually, Terry Smith, he's still a fund manager. He has a fund, actually, Fundsmith. But I thought that was very interesting. It's quite a UK-centric book. I don't know if you've read it, but it's quite a depressing.
Just parts of it. I haven't read the whole thing.
It's quite a depressing book in some ways. It's got plenty of examples of how things also go wrong and what to look out for, really, to identify accounting issues, etc.
So in the Accounting for Growth book, it is kind of depressing a little bit, but unfortunately there's hard realities of sometimes these things happen, and it's all about watching out and buyer beware type of thing. So, but I thought that was pretty interesting book myself. And then there's Black Swan, something that we deal with day trading, but you always got to be prepared for the Black Swan event. And what is the Black Swan event? What does that mean? And in our world, it's hope for the best, prepare for the worst, have your hedges on. You could wake up one day and the market could be down. Anything can happen. Some catastrophe in the world or whatever. You just have to be prepared. You have to have a plan. You buy a company and I'm expecting it or hoping that it does X or Y or whatever it is after you've evaluated it properly, of course, and taken the proper measures. But you also have to know what's going to happen what if it goes bad? What if it goes against you? What if it goes south? Is it because the valuation of the company or something changed in the company, or is it just a temporary blip like with COVID? What did you do with COVID? Who knew that the market was going to go down 30% and then in a month be back at all-time highs? Or not all-time highs, but basically bounce back. That was crazy as well. I bet if you asked a lot of investors when the market went down 30%, were we going lower? I bet 100% of them probably would have said yes. And that didn't happen. So I don't know what that proves. I don't know if that proves nobody knows anything, or I think honestly what it proves, and the reason for diversification is that you really have to, you buy your companies, you pick them. And I was looking at things when the market went down there, like the airlines. And I'm like, unless you believe that nobody's ever going to fly again, it could go down a little bit more, but it's got to go back. It can't stay down there forever. Things like Boeing and just different companies, but it's a scary thing.
This is where having a fundamental approach, in my view, helps, because it really does allow you to look through the noise. And COVID has been pretty awful noise, but as long as you feel that a company is financially robust, resilient through a crisis like this, like you say, people will fly again, people will consume again, go out again, eat at restaurants again. So all these companies over the long term, I think in 10 years back, hopefully we'll be looking back at this as a kind of blip in a company's history rather than an earthquake. And I write quite a bit about this in the book, actually, about understanding, and it comes back to your point actually earlier of when kind of fund managers were losing you money over the crisis. I think far too many people think about risk simply in terms of diversifying across many companies or many holdings, say, rather than factor risk. So what's the actual underlying risk of the company? Is the risk a high oil price? Is it political risk? And that's quite different in some ways. So, and in that way, it doesn't matter if you hold 50, 100, 200 companies. If you can diversify by factor risk, and emerging markets can incidentally help individuals do that, you can reduce your drawdowns quite considerably.
Yeah, exactly. I saw also you have some quotes on your website which I thought a few of them were pretty interesting as well. One by Peter Thiel: the most contrarian thing of all is not to oppose the crowd, but to think for yourself. It's pretty interesting.
I love that one.
I think that
so often there's so many people out there that just want to be contrarian for contrarian's sake. And it's so
Correct.
silly. You do get herd mentality and everything else, and there's issues with that. But I think it is just a great quote and kind of grounds things back to common sense.
I agree 100%. Also, prudence is in not avoiding danger, but calculating risk and acting decisively. Make mistakes of ambition and not mistakes of sloth. I like that one as well. That's interesting.
Machiavelli, the prince, I think that one, isn't it?
Yeah. Everybody just wants to feel that they have a little bit better grasp, like I said earlier. And there are a lot of things out there. Like you said, there's a lot of tools like on Yahoo Finance, and the internet's came a long way over the years. But I think at the heart of it, people need something that they can take research and look at and say, here's my plan. Or they read a couple books and they say, okay, I'm going to compile this and this, and this all sounds good. And here's my plan. And I'm going to start doing this and looking at these things and getting to work. So I think it's great that you wrote the book, and hopefully people will like it and pick it up and everything. Did you have anything else that you wanted to cover or go over?
I think those were the main points. Some great questions, though, certainly.
All right, Charles, I think we got some good stuff here. It was great having you on. I'm going to link to the book in the show notes on the website. You can also go to the Company Valuation Playbook.com website, where you can get more information about Charles. And it was great having you on.
Great. Thanks for your time, Rick.
All right. Have a great day.
You too.
So that's it for today's show. Let me know what you thought of it. I'd really appreciate it, and it will help make these shows better for you. Feedback is a very valuable tool to get better at anything. You can hit me up at Twitter at RickMaz1106, that's RickMaz1106, or on Instagram at RickMazur1, RickMazur1. Use the contact form on the website, rickmazur.life, and we'll also have everything in the comments section for each show page. I personally look at all the feedback on the site as often as I can. Finally, if you have anything to contribute or ask, or would like to appear on the show through an interview or one of our other segments, you can leave a voicemail at 1-800-590-0174 or by contacting us on any of our socials or use the contact form on the site. We'd love to hear from you. I consider us all a community, a group. Let's remember, in today's more challenging world, we are people first. We're humans who just want to be treated as such and live in a place where we can all prosper and live well. Bye for now. Until next time. See ya.